recording has started. Last time I was here, so we completed this example for the double declining balance method. And next method for the depreciation is next method for the depreciation is MAC-RS method. So which is the short for a modified accelerated cost recovery system. This method is a combination of the declining balance methods and the straight line methods. Okay. And under this system, because it is called as a system, because it is called as a system, so there are several other methodologies. So the most common methodology which is used is called as the journal depreciation system. Okay, so this methodology uses a double declining balance method, which we just discussed before. Double declining balance method is also called as the 200% declining balance method. So whereas in the double declining method, we take these variables such as the life and life of the equipment as a generic term. But here in this modified accelerated cost recovery system, MAC-RS, we take the depreciation for all property except the real property. And we take them in terms of 3 years, 5 years, 7 years, and 10-year period. Okay, so there are specified periods, 3, 5, 7, or 10 years. So actually, this type of methodology has a list of the type of equipment, and for each type of equipment, some type of recovery period, or that means the period over which the value of the asset will be depreciated is mentioned. So normally it takes these recovery periods, 3, 5, 7, and 10 years. And out of these different recovery periods, most of the construction equipment falls into a 5-year property. Okay, 5-year property. The real property is not depreciated. Okay, only the equipment is depreciated. By the real property, we mean is the houses, the land. So these are called as the real property. So these type of properties are not depreciated. Okay, but only the equipment and wear and tear type of equipment or the machines are depreciated. And most of the construction equipment falls into a 5-year property. So here we will only look at the examples of 5-year properties. So how this method works? So this method has an annual deduction for depreciation based on the initial cost. And for each year of the tax life, or that means the useful life. So tax life, if we take 5 years, so that means we are taking 5 years as the tax life, and without considering the salvage value. So this is one difference in this method compared with the previous method. In the previous methods, we may consider the salvage value. However, this method does not allow putting any salvage value. So if you take the life of an equipment, that means the tax life of the equipment as 5 years. So after 5 years, that equipment will be considered to have a 0 salvage value. Okay, it will be considered to have a 0 salvage value. And how the depreciation will be calculated? So depreciation will be some percentage depreciation in each year, first year, second year, third year, fourth year, and fifth year, will be some percentage of the initial cost, for which we use a term as the cost basis. Okay, cost basis. So which is the same as the initial cost, but it may also include some other items. So for example, in the cost basis, you can include the transportation cost of the equipment, the installation cost of the equipment, and other related costs for such as any tax which was paid to purchase the equipment, such as the sales tax. So these things can be included. Everything which you, most of the things which you spend initially to purchase the equipment. So these not only include the initial purchase price, but other related cost, as I mentioned just now. So that is called as the cost basis. So initial cost and the cost basis is same. So the depreciation will be some percentage of this cost basis. Okay, so the next other surprise in this MAC-RS system is the half-year convention. So that also makes this system different from the other systems, like we discussed previously. Some of the years method, straight line method, or the declining balance method. Over there, we did not talk about the half-year convention because those systems, some of the year straight line and declining balance methods, these are the generic systems. So in those systems, we assume that, so for example, if we are purchasing an equipment on the 1st of August this year, okay, so then the first year of that equipment will be spent by the next year, by the 31st of July next year. Okay, so if an equipment was purchased on 1st of July, 1st of August 2021, so the 1 year of that equipment will be completed on 31st of July 2022. However, in this system MAC-RS, we assume that because this system is mainly for the tax purposes, for the calculation of tax. So the tax year is normally the calendar year. Okay, so if we just assume the calendar year as the tax year, for example, 2021 is a calendar year, 2022 calendar year, these are also the tax years. So this system assumes that we will only allow the the depreciation for half of the year. So irrespective of when you purchase the equipment. So for example, if you purchase the equipment in the March of that year, so that equipment will be used like 9 or 10 months in that year. However, this system will say that no, you will not depreciate it for 9 months. That means for the 3/4 of a year, but you will depreciate only for half of the year. Similarly, if the same equipment was purchased in, say, near the end of the year in November, okay, so you will not depreciate the equipment for only 2 months. You will depreciate again for half of the year. So, well, this is the convention, okay, which is used. This is the convention. So it is not related to any scientific proof or like that. It is a convention. It is a choice. This type of convention is used only for the convenience. Okay, for the uniformity of the methods used across the years. Okay, so that's why it is called as the half-year convention. So it considers all the property placed in the service or disposed of during the year as having been acquired or disposed of at mid-year. So does it mean that it also relates with the disposal year as well? So for example, if an equipment is for a 5-year period, so its first year will be considered as the half year, and the last year will be also considered as the half year. So in total, we will consider 6 years. So for example, first is the half year, and in between there will be 4 years, and the last year will be considered also as the half year. So 2 half years and 4 full years, that will total make as 5 years. But in this case, in the calendar year terms, so for example, if an equipment is purchased in 2021, so 2021 will be considered as half year. Next 4 years, 22, 23, 24, and 25 will be considered as full years. And then the equipment will be disposed of in 2026. Okay, that will be considered as half year. So if you just consider by now in that sense as well, so you will see that starting from 2021, and then the equipment 5 years will be completed in 2026. So it's the same. But the thing is that the distribution will be like will be based on the calendar years, or in other words, if the calendar year is not the same as the financial year, so it will be based on the financial year as well. So in some countries the financial year starts in July, in some countries the financial year starts in April. So therefore this type of arrangement is mostly for considering the financial year as well. But anyway, for our simplicity, we just consider the calendar year. Okay. So anyway, so this is the meaning. So in this case, it will mean that if we have a property for which we have 5 years as the tax life, so we will depreciate that asset for 6 times. If it is for 7 years, we will depreciate the asset for 8 times. Okay. So in this case, for the 5th year, 6 times comes because first year will be the half year, 2nd, 3rd, 4th, and 5th year will be the full years, and the 6th one, that will be also considered as a half. So 2 halves and in the start and the beginning, and then some of them are fixed, are considered as full. Okay, so this is using the therefore, for the calculation purposes and how these percentages are calculated, it uses the 200% declining balance method and the half year convention. So the annual depreciation percentages are 20%, 32%, 19.2%, 11.52%, 11.52%, and 5.76% of years 1 through year 6 respectively. So it will mean that in the first year, you will depreciate 20%. And in the second year, you will depreciate 32%. So now you can see that if you consider these results from the perspective of the double declining balance method, in the double declining balance method, the maximum depreciation is taking place in the first year, okay? And then it is gradually decreasing. Can you see it? Hello?
Yes.
Yeah, so in this double declining balance, you can see that the maximum depreciation is in the first year, then decrease to second year, then decrease to third year, and then it is constantly decreasing because we are considering all these years as the full years, okay? But in the MAC-RS, first year is not considered as the full year. First year is considered as the half year, okay? So that's why in the first year, there is this much depreciation, and then there is an increase in the second year, and then gradual decrease till the 4th year, 5th year, and then in the last year it is 5.76%. So how these percentages are calculated? So this is because this is based on the 200% declining balance method and the half year convention. And if you see that, if you will add up all these 20%, 32%, 19.2%, 11.52%, and up to 5.76%, so the total will be how much? What is the total? Can you tell?
100.
Yes. So total is 100%. because this method considers no salvage value. This means that salvage value will be 0. Okay, salvage value will be 0. So maybe I can just illustrate how these percentages has come. So maybe I can open Excel. Okay, some Excel over here. Okay. Okay. Yeah. Yeah. So for example, here I have made these calculations. So for example, can you see it, Excel? So if I use the double declining balance method, okay. So in the double declining balance method, if you have the number of years, maybe I can say that n are 1, 2, 3, 4, 5, okay, like that. So how the value will decrease? So if it is for if total n is 5 years, so every year the value will be decreased by 40%. Okay. So it will be, that means the depreciation will be, what will be the depreciation? So the depreciation will be the book value. If, for example, if you take the book value in the start, okay, that in the start of the year, the book value, if in the start of the year, if you take the book value, say 100, okay, just for our reference, okay, if we take the book values, then the depreciation in the first year will be how much? Because if we take 2 over n, that is equal to 2 divided by 5 is equal to 0.4. So the depreciation in the first year will be how much? Hello, what will be the depreciation in the first year? It will be 100 times 0.4. So this will be the depreciation, 40. Okay. And the book value, so this is the book value at the beginning. Okay. Okay, the book value at the beginning and the book value at the end of the year. Okay, book value at the end of the year. So this is the year. Okay, and which is represented. This is the year. Book value at the beginning of the year is 100. Depreciation is 40. Book value at the end of the year will be the book value in the beginning of the year minus the book value minus the depreciation. So the book value at the end of the year will be 60. So this will be the same book value at the beginning of year 2. Okay, at the beginning of the year 2. So in the year 2 now, this will be sorry, I should change the formula. So it will be 100 times 0.4. Okay, so it will be 40. So the book value in the second year will be the 40% of this value. Okay, 40% of this value, new book value. And the book value in the end will be now book value in the beginning minus the depreciation and the book value in the end. Okay, so in this way, it will go like this. Okay, so these will be the book values. These will be the values of the depreciation in the double declining balance method. But in the MAC-RS, how will it go? MAC-RS. Okay, so it will, if you have the year. So first of all, if we take the MAC-RS and then if you take the 5-year property, 5-year property, that means 5-year equipment or 5-year equipment, that is the tax life. Okay, tax life, 5-year. It will mean in the MAC-RS, the 5-year property, it will mean that first year will be a half year. It will mean total 6 years. First year is the half year, second year is the full year, third year is the full year, fourth year is the full year, and fifth year is the full year, and the sixth year is the half year. Okay, so this is the half year. Okay, this is the half year, and then this is the full year. Okay, full year, and then this will be the half year. in the MacRS. So the depreciation, okay, so if we have the same asset over here, the depreciation will be half. Half of what? That means half of this 40, okay? So it will be 40 divided by 2. It will be 20. Okay, it will be 20 over here. And in the next year, it will be a full year of depreciation. Okay, it will be a full year of the depreciation. So how will it be? It will be calculated. It will be based on the book value. Okay, and since this is the depreciation, let me put it like this. Let me talk in terms of the book value in the beginning. Okay, in the beginning. So book value in the beginning in this case is also 100. The depreciation, it will be this value multiplied by 0.4, and then we will take half of that. So it will be 20, and the book value ending of the year will be the same 100 minus 20, it will be 80. So book value in the next year will be the same as the book value ending in the previous year. So now, because MacRS method actually applies the double declining balance method, but with half year of the convention. So it will be same, like 32%. It will be, 0.4. Okay, so here it is, because here we use the 0.2, but here we will use the 0.4. So it will be 80 multiplied by 0.4. Okay, so it will be, because this is the full year. So for half year, we will use the 0.2. For full year, we will use the 0.4. Okay, and then it will be this, and it will go on until year 4, and we will get the same values: 20%, 32%, 19.2%, 11.52%. Okay. And if I go for the next half full year, we will get this value. We will get this value. And if we go to the here, we will get 6.22 value. But here, I think we will need to make some adjustments. Okay, in this area, we will need to make adjustment. Here, another condition of the MacRS systems comes, because without salvage value. Okay, without salvage, that means there should be full 100% depreciation. So here you can see that we got these values: 20%, 32%, 19.2%, 11.52%. 1, 2, 3, 4. And the fifth year, it should be also 11.52%. And thus in the sixth year, it will be 5.76%. Okay. So what actually has been done over here is that I was looking at it here. What actually, so here we need to make some changes. So what actually has been done over here is that we will need to change the depreciation method, because you can see that by the double declining balance method, we cannot reach the salvage value of 0. So if we want to make the salvage value of 0, so we have to depreciate this asset by some other method over here. Okay, by some other method over here. So what is that method over here? So now at this point in time, we have left, what we have left is 1.5 year. So this 1 full year and 1.5 year. So we have left 1.5 year. So if we distribute this, and then how much we have to depreciate? We have to depreciate this much amount, 17.28. Okay. So if we have to depreciate 17.28 in 3 portions, so we can take, because here we have, here we will have full year, here we have half year. So what will be the proportion which we will use over here? So out of 1.5, we will use a portion of 1 here and half here, right? Because this is a half year, this is a full year. So this means that we will depreciate 2/3 of that amount, okay, multiplied by 2/3 of that amount here. So that's why we will get 11.52. And then we will depreciate 1/3 of that amount here. Then that's why we will get 5.76. So in this way, then the ending book value will be here, and the ending book value over here will be 0. So this is correct. So this is here we can meet the requirement. So now we have the 0 salvage value. Now we have the 0 salvage value. So this is one of the requirement of the MAC-RS. Okay. So therefore, this is how we have got these percentages over here.
Professor, can I ask a question?
Yes. So I'm waiting if someone asks questions.
Again, please, can you repeat what is the percentage for each year in the second method?
Yeah, this is the one: 20%, 32%, 19.2, 11.5. But these percentages we have calculated based on this double declining balance method. Remember that in the double declining balance method, each year was 40%. Okay. However, we have applied the same method over here, but in the first year is considered as a half year. So instead of 40%, it will be 20%. Okay. And from second to fourth year, it is full. Then we applied the 40%
then I got,
of this.
What does mean half year, full year? I mean, why half year?
Why half year?
Yep.
Because this is the a half year convention. And this system, MAC-RS, is a standardized system, okay? Whereas the double declining balance method is a generic system. So this double declining balance method assumes that whenever you purchase the equipment, so for example, if you purchase the equipment on 1st of August, the next year of that equipment will finish on the next year. That means next year, 31st of July. That will complete. But in the MAC-RS, to make the things simple, it assumes that whenever you buy the equipment in a year, you will consider that calendar year as the half year. Okay. So for example, if I talk in terms of the calendar year, so it was 2021, 2022, 2023, 2024, 2025, and 2026. Okay, so 2021 and 2026 will be considered as half years, although it is a 5-year property life, but since first and last years are the half years, so that's why we have a total of 5 years for the depreciation.
So 2021, you mean like we bought the equipment in the middle of 2021? Yep.
We assume that in the middle of the, but in actual, it can be anywhere. It can be any time between 2021, even in the month of January, if you will bought it, although you will use for in 2021 for like 11 months, but still you will consider that it is for 6 months, or even if you will bought in 2021 in the near the end of 2021, so we will still take it as a half year. Okay. So this is the convention.
I'm sorry for inconvenience. Why half year? So why? Maybe I listened, but it's a little bit complicated. So why half year?
Why half year? So that's what I have said, that this is a system, MAC-RS system. So that means to make the calculations easier for the tax purposes, to avoid any, for example, some dispute when you make the claim for the tax deduction. So therefore, the government allows it to apply this system. So based to consider as half year. So
like a code, yeah.
Yes, it's like a code. Yeah, it's like a code. Okay.
Okay.
Yeah,
Thank
it is
you.
not based on any scientific evidence. Okay, it is just like a code, some rule which needs to be followed.
Okay, thank you.
Okay, so I
It is
have spent
applied
all.
in now it's in US, yep, for instance. I mean,
Yes, yes.
not DDB, yep, MACRS is applied now, actually.
Yes,
Yep.
MACRS is a system. DDB is just a generic method which can be applied anywhere. But for most practical purposes, MACRS will be used,
Okay.
or any other method which companies which country's government will specify. So, but most likely they will specify the method on the same rules as MACRS, similar rules. Okay. So MACRS follows the calendar year, but DDB is a generic method. So in those cases, the years 1, 2, 3 can be any, like year 1 can be anyone, right? Okay, so I have spent all this time just to explain these percentages over here. Okay, so now I think it should be clear to you how these percentages have come over here in this case. 20%, 32%, 19.2, 11.52, and 5.76% of years 1 through year 6. Okay, so now let's apply this. So for the loader of example 1, find the annual depreciation and book value at the end of each year using the MACRS method. So just in case if you have forgotten what was the loader of example 1, loader of example 1 was having a cost basis of $50,000 and the salvage value of $5,000 and the lifespan of expected life of 5 years, which is the same we are taking as the tax life over here. So now, since I have already explained these percentages, how these percentages are calculated, and then you can see that adding up all these percentages, it comes out to be 100%, which means that in this case, in the MACRS method, salvage value does not play any role. So salvage value have to be 0 at the end of the year. But remember that it is taking into consideration the 6 years total. Although we are saying it as a 5 years, but total it is for the 6 years, because first year and the last year are the half years. And then we just have these percentages is 20%, 32%, 19.2%, 11.52%, 11.52%, and 5.76% from 1 to 6. And then we simply multiply by their initial $50,000 without any regard of the salvage value. Okay, so you will not take 50,000 minus 5,000 over here. We will just take 50,000 over here. And in this way, the book value at the end of the 6th year will reduce to the 0 over here. So in this way, the depreciation will take place. Okay. So now we can just compare this with the different methods. So you can see that where the depreciation is taking place. So therefore, remember that the main discussion for the depreciation calculation is for the calculation of the tax purposes. So since there are various methods of the depreciation, sum of the years method, straight line method, double declining method, and now we have the MACRS method. So MACRS method gives the advantage that because it applies by the application of this method, there is a uniformity in the application. So for example, if one contractor is using the sum of the years digit method, another contractor is using the double declining balance method. So maybe there will not be a uniformity. So since this method, if it is specified by the financial department of the government, this method or any other method based on this or some other system, then it will introduce a uniformity in the for the tax applications of the different companies. Okay, so this is one of the advantage. Okay, so next we consider the investment cost. Investment cost or the interest represents the annual cost converted to hourly cost of the capital invested in the machine. Remember that our discussion has become quite long since the beginning. We are just recall that we are talking about the mainly about the costs related with the equipment. So for the costs related with the equipment, we need to consider different types of costs. So investment cost is one type of that cost. So investment cost can be a borrowed amount, or it can be the own capital of the contractor as well. So if it is the borrowed, if the borrowed funds are used, it is the interest charge on these funds. So if you take this loan, then whatever the interest which you pay, that is considered into the investment cost. If the equipment is purchased from company assets, an interest rate should be charged equal to the rate of return on the company investment. So in both cases, the interest on those capitals which were borrowed or which were used from the own funds should be charged. Thus, the investment cost is computed as the product of an interest rate multiplied by the value of the equipment and then converted to the cost per hour. We will see this in one example later on. Additional costs are the insurance, tax, and storage. Okay, so when an equipment is purchased, so some additional costs are also incurred, which are the insurance costs. So insurance cost represents the cost of fire, theft, accident, liability insurance for the equipment. So when an equipment is purchased, its insurance is also purchased. So this means that in case such as in the case of the fire, theft, or accident, the company may get some amount from the insurance company. So to get that amount, in that case, the company pays the premium to the insurance company. So that is one component of the cost which should be considered in the for owning the equipment. Then tax cost represents the cost of property tax and licenses for the equipment. So for various types of equipment, we may need some license to operate it. We may also need to pay some sales tax, or in other case, some property tax on the equipment. So these are also the costs. So of course, we can know about these costs when we are actually purchasing those equipment, and then we can find what these costs are really. But later on, I think that there are some ways to also estimate as well. Storage costs represent the cost of the rent and maintenance for the equipment, storage yards and facilities, the wages of the guards and employees involved in handling equipment in and out of the storage, and associated direct overheads. So these type of costs. So of course, some of the equipment, they are the large machines, they needs to be stored, so their storage costs need to be considered. So the cost of insurance and taxes for each item of the equipment are used as the cost per hour of these items. And the storage are on an annual basis for the entire equipment fleet. So there is remember that for each type of costs, it is very convenient. It is convenient for comparison purposes to convert all these costs for the cost per hour of the usage of the machine. So insurance costs and the taxes costs can be are normally converted to the cost per hour of this equipment, whereas the storage costs are on the annual basis for the entire equipment fleet. Normally happens like that. Next is the total owning cost. So up to now, we were only talking about the owning cost. That means how we can own that equipment. So we need the need to consider the depreciation cost, investment cost, the cost of insurance, taxes, and the storage. So total, if we sum up all these values, then we can get the total owning cost. So the elements of owning costs are known on an annual cost basis. However, whether the individual elements of owning costs are calculated on an annual cost basis or an hourly basis, total owning cost should be expressed as a hourly cost. Okay. Okay, so we have considered one aspect of the equipment cost. Next, we are going to consider the operating costs. So which are the costs which depends on the usage of the machines. So can you tell me what is the difference between the owning costs and the operating costs? Can anyone tell? What is the difference between the owning cost and the operating costs?
Maybe owning is more connected to renting and operating is to the functions of the, yeah.
You can be considered a little bit, partially correct. But for the owning, we say that these are the costs. Renting is one aspect of the owning costs. Yes, these are the costs which do not depend on the usage of the equipment. Okay, you buy the equipment, you keep them, but if you don't use it, we still have to pay those costs on an annual basis. Okay. Whereas the operating costs are those costs you only have to pay if you will use that equipment. Okay, so this is the operating cost depends on the usage, and the owning cost do not depend on the usage. Okay, so operating costs are the fuel costs, service costs, repair cost, tire cost, special items, and operator costs. And then we have the total of the owning and the operating costs. So we will look at these different costs one by one. So what is the fuel cost first? What is the operating cost first? So operating costs are incurred only when the equipment is operated. Therefore, costs vary with the amount of equipment. Wait a minute, this is something here. Okay. Yes. So therefore, costs vary with the amount of equipment use and job operating conditions. Okay. So these costs will vary with the amount of more the equipment will be used, more will be these costs. And more difficult are the operating conditions, more will be these costs. The operating costs include operators' wages, which are usually added as separate item after the operating costs have been calculated. So operators' wages, although the wages for the operators are considered to be the human resources costs, but often these costs are also added to the equipment's cost. Okay. Okay, so what is the fuel cost? First of all, there is the fuel. So hourly cost of fuel is simply the fuel consumption per hour multiplied by the cost per unit of the fuel. That is the gallon or liter. Okay. So simply we can just, so there is a simple formula for normally for the fuel cost is known, and then we multiply the overall consumption of the fuel with the price of the fuel, and then we can get the cost per unit of the fuel. So actual measurement of the fuel consumption under similar conditions provides the best estimate of fuel consumption. Okay. However, when historical data are not available, fuel consumption may be estimated from manufacturer's data by the use of table 1. Remember that here we are talking about planning for the equipment, okay? That means we are going to estimate the cost of the equipment. So of course, the actual costs, actual fuel costs will only be known when we are actually be using it. But this is not the case over here. Here we want to estimate the cost. So for the estimate of those costs, we should have some historical data available, or in other words, of course, these are very significant equipments, loaders, trucks, excavators, cranes. So their manufacturers will provide some data about the normal usage of those equipment, or maybe in some or their usage in some different conditions. So manufacturers' data can be also very helpful for estimating the fuel cost of the equipment. Or in this book provides a table as well. So you can use this table to estimate the cost of the fuel. So for example, in this table, if we say that if we have a track loader, okay, so this track loader can be considered to consume 0.03 of fuel, okay, under the load conditions, which are the low, average, severe. So under the there are 3 types of working conditions: low, light work, or considerable idling. So low means light work or considerable idling. Okay. If you want to have the average, so these are the normal load and operating conditions. Severe means the heavy work, and there is a little idling. So if we have the work, so we have to be we have to be judgmental about the working conditions, and then we can apply these figures. So in what type of conditions the machine will be used mostly. So in that case, if that is the situation, so the fuel consumption factors have been given as 0.03, for example, for the track loader. For the crawler tractor in the severe condition, the fuel factor is given as 0.046. And these are considered to be the gallons per hour per horsepower. So if the machine is say for 100 horsepower, and then it is to be used for like if we, for example, if the machine is a crawler, so it will be 0.046. We will multiply it by the horsepower of that. So it will be 4.6. So it will be 4.6 gallon per hour for a 100 horsepower machine. Okay. So in this way, the fuel costs, fuel consumption can be calculated, and then fuel consumption can then multiplied by the price of the fuel. Then we can calculate the cost of the fuel per hour. Okay, so this was the fuel cost. Similarly, in addition to the fuel cost, there will be the service costs. It represents the cost of oil, because in addition, we have to provide some lubricating oils, hydraulic fluids, greases, and filters to the machine, as well as the labor for those changes which need for those maintenance tasks which are provided to the machine. So equipment manufacturers publish consumption data or average cost factors for oil, lubricants, and filters for their equipment under average conditions. Service labor cost may be estimated based on the prevailing wage rates and the planned maintenance program. Okay, so many of these things can be calculated separately, or in another word, we have also for our guidance a table number 2. So since the service cost is related to equipment size and severity of operating conditions, a rough estimate of the service cost may be made based on the equipment's fuel cost. Okay, so if we firstly calculate the fuel cost from this table number 1, Then we can calculate the service cost factor based on these factors. So if the conditions are favorable, then 20%. If the conditions are average, then 33% of the fuel cost. Severe, then 50% of the fuel cost. So it can provide us a rough estimate of the service costs. Okay. In addition to the service cost, there can be the repair cost. So repair costs are not the service cost. Repair costs are in addition to the service costs. It represents the cost of all equipment repair and maintenance, except for tire repair and replacement. Okay, so for the repair and maintenance work does not include the tire repair and replacement, because the tire are the things which are more frequently or replaced on more regular basis. And similarly, the routine service, which is considered in the previous case, is not included. And also not included in the replacement of high wear items such as the repair teeth. That means those teeth or those sharp objects which are on the front end of the machine. They may need to be often changed, or they may need to be changed on regular basis. They may not be included. So repair costs are mainly those costs which may happen as a result of some breakdown of the machinery. So repair costs usually constitute the largest item of the operating expense for the construction equipment. So although many of the things are not included, but they often have quite a large amount of the operating expense because the construction work or the construction machinery's work is quite rough work. There is a lot of effort, lot of forces which are involved, which may have an effect on the machine. So therefore, these are often quite large items of the operating expenses. So the lifetime repair cost is usually estimated as a percentage of the equipment's initial cost less tires. So over the lifetime, it can be estimated using this table number 3. And then we can convert these lifetime repair costs to the hourly cost. We can divide them by the number of hours we can estimate for that machine to last for. So this may be done simply by dividing the lifetime repair cost by the expected equipment life in hours to yield an average hourly repair cost. Also, it is suggested that we can use this following equation to obtain a more accurate estimate of the repair cost during a particular year of the equipment life. So remember that earlier we have said that we can use this table number 3 to estimate the lifetime repair cost. So for example, if the lifetime is for 5 years, so this table number 3 that we can see over here will provide us the value of the repair cost, which can be estimated over the life of the year. So for example, if I say a motor grader, so under the favorable condition, it is 45% of the initial cost of the equipment minus the cost of the tires, okay? Or it is 50% for in the average condition, or 55% in the severe condition in the case of the motor grader. But remember that here we are getting what we are getting is the overall for 5 years. Say, for example, if the life of the equipment is 5 years. However, because we also want the repair costs to be distributed in the years, right? So for example, for 5 years, we know that the repair cost is $50,000. So is it correct to assume that the repair cost in the first year will be $10,000, $10,000 in the second year, and similarly in the all remaining years, it is $10,000? Or it will be more correct to assume that the repair cost in the earlier years will be less, and it will gradually increase in the later years. So which one will, which option will be correct? So because normally the for the new equipment, we need less repair when the equipment is new. When the equipment is used and the equipment becomes gradually old, we need more repair. Okay, so therefore we can see that the repair cost can gradually increase from the earlier life to the later life. So in this case, we can use this sum of the years digit formula in the reverse order. Okay, remember that in the depreciation, we use the year digit in the descending order. Okay, but here we can use the year digit in the ascending order. So if it is for 5 years, so we will use 15 in the denominator. And for the first year, we will use 1. Okay, in the case of depreciation for the first year, we will use the last digit in the descending order. That means it was 5. Okay, so whereas in this case, the depreciation we will take much higher in the earlier years, we will consider the repair costs much lower in the earlier year and much higher in the later year. So therefore, we can even use this formula for the hourly repair cost to calculate the repair cost in a particular year. Okay. So do you understand this point? I wonder if anyone is listening, right?
Yes.
Yes.
Okay. Yeah. So my point was that the repair cost by using this formula will be calculated, and for the year digit, it will be used in the ascending order. So for example, for year 2, it will be year 2 over here. But we use the similar formula in the depreciation in the sum of the years digit method. But over there, the year digit was used in the descending order. But here we are using the year digit in the ascending order because we can assume that in the earlier years, there will be less cost that will be involved in the repair cost, because we are assuming that we have bought the equipment new and then we have used it gradually over the years. Okay, so then I have explained this point, and everything is being recorded, so you can listen it later as well. Okay, then, okay, now let's look at this example 5. Estimate the hourly repair cost for the first year of operation of a crawler tractor consisting of $136,000 costing $136,000 and having a 5-year life. Assume average operating conditions and 2,000 hours of operating during the year. So in this case, what we can see over here is that we have lifetime repair cost factor is 0.9. So this value we get from table 3. So in table 3, what we have over here is the crawler tractor and what conditions? Average operating conditions. So I can go to the table 3. Table 3. So where is the crawler tractor? Yeah, crawler tractor is here. And for average conditions, I have the operating condition is 90%. So I can go back to this example 5. So I can see over here is that the lifetime repair cost will be the 90% of this initial cost. So we can estimate that $122,400 will be the lifetime repair cost. So out of this $122,400, in the first year, it will be 1 by 15 because sum of the years digit is 5 years. So in the first year, it will be 1 by 15 of this $122,400. And on per hour basis, because we can use, we are using it for 2,000 hours per year. So we can divide it by 2,000 hours. So hourly repair cost in the first year will be $4.08. Okay, is it clear at this point?
Professor, why 1/15? Can you please?
Yes, here. Because here this 122,400 year is the cost for the whole 5 years. This $122,400 is for the cost of whole 5 years. So in the first year, it will be 1/15 because 15 is the sum of the year's digit. So we will assume that in the first year, very less repair will be needed. Okay, if we just uniformly distribute it, like then we will use like 1/5 only, right? But since we say that the equipment is new at the beginning, in the first year we will use less repair, so it will be 1/15. If it is for the third year, it will be 3/15. Okay, years digit 3/15. Okay. And if it will be for the fifth year, it will be 5/15. Is it clear?
Yep, I now I understand why, but it's little. So in the fifth year, it will be 5/15, not 1.
Yes.
Yep.
Yeah, in year 5, it will be 5/15. In year 4, it will be 4/15.
I got it. I got it.
So you will you will assume that accordingly, gradually the cost of repair will increase over the life of the machine. Yeah, we are assuming that the cost of repair will increase over the life of the machine, starting from 1/15, 2/15, 3/15, like that. Okay.
Okay, got it.
Professor.
Next
I have
is the
question.
tire cost. Okay, so it represents the cost of tire repair and replacement. Okay, so among because tires are one of the most common costs, so that's why they are considered separately. So among operating costs for rubber tired equipment, tire cost is usually exceeded only by the repair costs. So for in the rubber tired equipments, tire cost is quite significant because a machine, a truck, normally a truck may have, let's say, not just one tire, it may have, let's say, 20 tires to be replaced. So it's quite a lot of cost. So the historical data obtained under similar operating conditions provide the best basis for estimating tire life. However, table 4 may be used as a guide to approximate a tire life. So tire repair will add about 15% to the tire replacement cost. Okay, so the tire cost has two components: tire repair cost and the tire replacement cost. So first we will calculate the replacement cost using the table number 4. Okay, so the replacement cost for those type of equipment which use tires, so for example, dozers and loaders, motor graders, scrapers, trucks and wagons, their typical tire life is given in terms of this. Okay, so for example, trucks and wagons will use 3,500 hours of the tire life, and then we can use this tire life. Okay, and then from the manufacturers, we will know that we will know the cost of a set of tires. Okay, so if you will take the cost of the set of tires in dollars, and then we can divide by the hours. So that will be the dollar per hour for the cost of tires. And then if you increase, if you add 15% to that for the repair as well, because you don't always replace the tires. You can even repair them but that repair will cost about like by some experience before that repair will add about 15% to that. So in this case, in this way, you can calculate the tire cost by this formula. Okay, cost of a set of tires divided by the expected tire life, which we can obtain from the table number 3. Okay, so that is the typical tire life. In addition, we have some special items. So what can be those special items? So these are the cost of replacing high wear items such as a dozer, grader, and scraper, blade cutting edges, and end bits, as well as ripper tips, shanks, and shank protectors should be calculated as a separate item of operating expenses. So as usual, unit cost is divided by the expected life to yield the cost per hour. Then in addition, we have the operator cost. So final item making up the equipment operating cost is the operator's wages. So care must be taken to include all costs such as workers' compensation insurance, social security taxes, overtime or premium pay, and fringe benefits in the hourly wage figure. So whatever the wage is there, so for example, $20 per hour or $25 per hour, and then in that amount should include all those benefits which are given to the labor or to the operator. That should be also included. So total owning and operating costs. So after owning costs and operating costs have been calculated, these are totaled to yield total owning and operating costs per hour of operation. Although this costs may be used for estimating and for charging equipment costs to products. Notice that it does not include overhead or profits. Remember that up to now, we have not included any overhead and profits. So these overhead and profits needs to be added as well. So hence overhead and profit must be added to obtain an hourly rental rate if the equipment is to be rented to others. Okay, so now let's look at this example number 6. So calculate the expected hourly owning and operating cost for the second year of operation of the twin engine scraper described below. So its cost is for the delivery cost is $152,000. Its tire cost is $12,000. Estimated life is 5 years. Salvage value is $16,000. The depreciation method is the sum of the years digit method. Investment rate is 10%. Tax, insurance, and storage rate is 8%. Operating conditions are average. Rated power is 465 horsepower. Fuel price is $101.3 per gallon. Operator's wages are $32 per hour. So this is the data which is available. So now we have to calculate the total owning and operating costs. So we can start from calculating the depreciation. So since it is said that we need the depreciation in the second year of the operation. Okay, so for the second year of the operation, if we are using the sum of the years digit method, so first of all we will take the cost, which was $152,000. You will subtract it the cost of the tires, and we will also subtract the salvage value. So I think one of them was the salvage value, and the other was the cost of tires. So for the depreciation, we do not depreciate the tires and the salvage value because these costs are separated separately. And then for the sum of the years digits method for the second year, and you will use the value 4, because if it is for the 5 year, then from 5, 4, 3, 2, 1. So 4 comes on the second place. So we will take 4 over here, and the sum of the years digit is 15. So if you will calculate it, this comes out to be $33,067. And hourly depreciation will be at $32,067 if you will divide by the 2,000 hours. Because we have said that we will use this machine for 2,000 hours per year. Did it say somewhere? No, yeah, actually it is not said somewhere, but for normal operation. So for example, if you take 52 weeks in a day, in a year, and each week we have 5 days, 5 working days. So you take 5 working day a week. So if you multiply 5 by 52 and then take like 8 hours per day. So the answer will be nearly a little bit more than 2000. So for rough estimation, we take 2000 hours usage. Okay, 2000 hours usage. So 33,000 divided by 2000 divided by $16.53 per year, per hour. So once we have this depreciation value, next we need to calculate the investment tax, insurance, and the storage cost. So for this, some data has been given, is that, so the investment rate was 10%. Investment rate was 10%, and the tax, insurance, and the storage rate was 8%. Okay, so the total of this investment, tax, insurance, and storage rate is 18%. Okay. So for the rough estimation, we will use the average investment over the life of the equipment. And the average investment over the life of the equipment is initial purchase price $152,000 plus the final salvage value, which we also estimated before, like this $16,000. So average of this is $84,000. So average investment. So this average investment will be multiplied by this cost rate to calculate the cost for the investment, tax, insurance, and the cost. So $84,000, it will be multiplied by 18%, and then you divide by 2000 hours of the usage. So it will come out to be $7.56 per hour. So this will give us the total owning cost, which is the depreciation cost and plus the investment, tax, insurance, and the storage cost, etc. So it is $24.09 per hour. So this is the total owning cost. In addition, we have now to calculate the fuel cost as well. So for the fuel cost, we can calculate the estimated consumption, which is, for this we need this consumption factor 0.035 from table number 1. So for using this table number 1, what we have over here is that engine scraper in the average conditions. Okay, average operating conditions are average. So I go to table number 1. It is scraper. Okay, it is a scraper and average conditions. No, this is not table number 1. Table number 1 is here. Yeah, it is scraper and average conditions. So we have the 0.035 value. Okay, so we will use this 0.035 value, and then we have to multiply it by the horsepower of the machine. Okay, so this will give us 0.035, and then we are using a 465 horsepower machine, right? So 0.035 multiplied by 465. So this machine will use 16.3 gallons per hour. So the fuel cost will be 16.3 multiplied by 1.3. That is, the fuel price was $1.3 per gallon. So it will make it like $21.19 per hour. That will be the fuel cost. Okay. The service cost will be 33% of this. So this we can see from table number 2. Okay, service cost will be 33%. Table number 2. Yeah. So average, for average condition, it was 33%, and it is 33% of the fuel cost. Okay, so I go back to here. Yes, it is the fuel cost. And then the repair cost for the lifetime repair, we have this 152,000. We have to subtract out the cost of tires from there, and it will be 90% of that from table number 3. So we will see from table number 3. Why is it 90%? Because it is a scraper, and in the average condition, it is the 90%. Okay, of that. 90% of this value. for the initial cost minus the cost of tires. So it is $126,000. In the second year, okay, so we will use the sum of the years digit formula. So in the second year, we will use the yearly digit as number 2, then divide by 15. And then we will divide by the number of hours it is used. So it will be $8.4 per hour. So this is the life repair cost in the second year will be $8.4 per hour. And finally, the tire cost, estimated tire life will be 3,000 hours. So we can see it from table number 4. Table number 4, the tire life will be 3,000 hours. So scraper, we have this scraper, and it is a twin engine scraper. It has been said before. So it will be 3,000 hours. Yeah. Yeah, twin engine scraper. So it was 3,000. Okay. So 3,000 hour was the tire life. So the tire cost will be the tire life 3,000 hours is here, and divided by the tire cost is 12,000. 12,000 divided by 3,000 and multiplied by the 1.15 for the repair of the tire. So it will be $4.6 per hour. Special item cost, no information has been given for that, so therefore we will not consider it. Operator wages are given as $32 per hour. So now we can add all these costs, 21.19, which was for the fuel, and then 7.06, which was for the service, 8.4, which was for the repair cost, 4.6, which was for the tire cost, and 32, which was for the operator. So total will be $73.25. So this is the total operating cost. So total O&O cost, that means the total owning and operating cost, it will be 24.09, which was the total owning cost, and then the total of the operating cost, which is $73.25. So it is $97.34. So remember that here we have total owning and operating cost. We have not added any overhead and profit, which needs to be further added if we want to rent out this machine. Okay, so I have exceeded some time. So anyway, we have completed up to this point. Okay. So how many slides we have completed? 44 out of 65. So we have few slides left. So I think I will need one more lecture to complete this topic. Okay. Please, now I can pause this recording. Do you have any questions?